Hello, chart watchers, and welcome to this Friday, January 11th, 2019 Market Watchers Live Show with your host, Tom Bowley and Mary Ellen McGonigal. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, once again, second day in a row, we've seen the market gap down at the open, but it is resilient, bouncing back. Currently, the Dow Jones Industrial Average is down 66 points, but it is off its earlier lows. The S&P 500 down 5, but also moving off of its earlier lows. NASDAQ struggling a little bit more on a relative basis, down 27 points currently, and the Russell 2000 down 4. So we are across the board down today, but the market is trying once again to come back. 10-year Treasury yield, though, appears to be rolling over. It is now down just below 2.70%. It is down more than 3 basis points this morning. Something to keep an eye on as money rotates into Treasuries. The yield goes down. Of course, money going into Treasuries cannot go into equities. Volatility index continues to be under pressure, though, to the downside. This is very bullish. As long as we continue this trend to the downside and we can take out those earlier lows, this would be a very, very good signal for the bulls. Currently, the volatility index, or the VIX, down 0.32, which is down about 1.6%. Interesting, especially since the overall market is down right now. Leading to the upside, we've got consumer discretionary. This was the weakest group yesterday as a result of Macy's and a few other retailers posting warnings or weak holiday sales. But the XLY is up today. Financials also having a pretty good day. Nice bull flag here on the financials, as you can see. Move up, sideways consolidation, trying to make a breakout. Consumer staples also having a nice day. So we got a daily double on the consumer stocks. And to the downside, though, utilities struggling. A little bit of concern maybe there with the utilities faltering because the 10-year Treasury yield is dropping. Normally, that's a good thing for the utilities. And then energy. We've seen such a huge run-up in crude oil prices recently. We did see a move from about $42 a barrel to $52 a barrel. That's coincided with a really nice rally in energy. But there is overhead resistance between 62 and 64. And at least for now, we are hesitating in that area. General Motors, the best performer on the S&P 500. They did raise guidance this morning. That definitely bodes well. We've not just had warnings to the downside. We've also had some pre-announcements to the upside. We'll talk about a couple of those in just a bit. But first, I'd like to wish Mary Ellen McGonigal a Happy New Year and welcome back to the show. How are you doing today?
Oh, I'm doing well. Thank you. Happy New Year to you as well. I guess that's something we can keep saying throughout January. But yes. It's been an interesting New Year, to say the least, certainly as it relates to the markets and what we've seen over the last week.
Yes. And I know you were under the weather last week, so you sound much better than what I heard you sounded like.
Oh, man. This flu season is a doozy. Those of you who have not, I urge you, get that flu shot because it'll knock you right off your feet.
Yeah, I heard that you were not doing too well, and as a result of our show not airing the last couple of weeks, and then you being sick last Friday, I mean, we've had a completely different change. I know, your regular segment, that what's hot, what's not. When you were on last time, it was like we were joking. There probably wasn't anything hot because the market's going down. Now it's the other way around.
You're absolutely right. Yeah, we'll get into that, but it's just a very interesting phenomenon, for lack of a better word, as far as the action that we are seeing this week. It's not typical of what you would see in a normally bullish environment. Yeah, they're picking everything up off the ground and elsewhere. So lots on the upside, that's for sure.
All right. Well, we got a lot to go over today. We're going to get into all of that in just a couple minutes, but let's go ahead and go through the upcoming schedule and then, of course, today's agenda. And as we look forward, well, I'm going to be doing a workshop tomorrow, and I think I'm going to be looking at tops and bottoms, identifying tops and bottoms. Could be in the overall market, could just be in individual stocks. But from a trading perspective, that's really important. So I think that's what I'm going to focus the workshop on tomorrow. David Keller will be in with us on Wednesday of next week. It's always a pleasure to have Dave on. And then, of course, Julius de Kempenaar will be back with us next Thursday. So you want to stick around and see those great guests and see what they're doing with the market. I mean, obviously, there's been a lot of changes over the past few weeks. And then we're going to get into today's agenda. Of course, Mary Ellen will get into her what's hot, what's not. Keep you posted there if you have not been here before. and listen to Mary Ellen go through that what's hot, what's not, you're going to hear a number of different areas, a lot of stocks. She does an amazing job getting through an incredible number of stocks over about a 30-minute period. And then we're going to get into the 10 in 10. Our first stock today will be Dow DuPont, DWDP. Stock has been rising recently, but it is up against some overhead resistance. So we'll take a look at that one and then give you 9 other stocks I'll annotate and give you some key areas to watch for. And then we're going to wrap up today's show with the cyclical versus secular bear market. Mary Ellen and I haven't talked about it. Of course, here on Market Watchers Live, Aaron and I have spoken about this quite a bit. We've had guests on to talk about it. So that'll be a treat. We'll get Mary Ellen's take on what to do in a bear market and some of the things that she looks for. All right, let's jump in. We did have one major economic report today, and that was the inflation report, the Consumer Price Index, CPI, for December. Came in exactly as expected. When we strip out the more volatile areas, the core CPI also matched estimates, rising 0.2%. So there were no big surprises for the market in terms of the economic report. So let's take a look and see what the bond market is doing with that data. And as I mentioned, it looks like the 10-year Treasury yield is rolling over, although we are off the earlier lows. I'd like to see, from a bullish perspective on equities, I'd like to see the TNX reverse and make a break above this 20-day moving average. We have not seen that over the past 2 months. And of course, one of the problems in the market, at least in the equity market, is that when the yield is dropping like this, that means money is rotating into treasuries. Treasury prices are going up, and every dollar that goes into treasuries cannot go into equities. So you typically, when you see the 10-year Treasury yield dropping like this, that normally coincides with market weakness. That's exactly what we saw. Now, the S&P 500, if you recall, bounced around the 26th of December, and the 10-year Treasury yield kept moving lower into the early part of January. So I don't know. I tend to pay more attention to what's going on in the Treasury market. I think the Treasury market tends to get things right more often than the equity market. So I would really like to see the TNX break this downtrend, get back through the 20-day, and start to trend higher. We'll see whether or not that is the case. We are off the earlier lows. So that's a good thing. All right, let's take a look at the earnings. Not a whole lot going on in terms of earnings just yet. Infosys reported last night after I think it was this morning before the bell. But they came in 14 cents versus 13 cents. And then, of course, as I mentioned yesterday, next week, these are all companies that have market caps above $100 billion. So these are very influential stocks. They're going to be coming out next week. And then the following week, we'll even get inundated with more and more stocks. So earnings season is getting ready to kick off. And this one is going to be interesting based on the huge dive that the S&P 500 took in the fourth quarter. I think you'll see a number of companies maybe not meeting their expectations for the fourth quarter. I think that's what the market is telling us. But for me, it's going to be about guidance going forward. And when you look at some of these banks, especially the yield curve narrowing and getting closer and closer, you have to wonder if that's going to impact their guidance going forward. So a lot of really good stuff coming out next week. We'll keep you posted on all of that, as we always do. All right, let's take a look at some, first let's take a look at the INFY chart, which is the company that just reported. And here you can see that the reaction was very positive. Nice. Look at the volume already today. Huge gap up. It was making a breakout earlier, and now it is failing. Of course, we're not even halfway through the trading day. So let's see how we close. But a break back up above the September high here on INFY, I think, would be extremely bullish. I'm going to pull up the relative chart that I like to use. And when we take a look at that, you can see relative to its peers have been very weak, and the stock's trying to break out. So when you see that, you know you have a strong group within, or a strong stock within its peer group. INFY also has been very strong relative to the S&P 500, and it's doing so with a group that really has not been performing well versus the S&P. They topped back in April. So all in all, this is a really good stock within a suspect group, and that's why I would be very careful with a false breakout. If the group's not doing well and the stock has a false breakout, I'd need to see that closing breakout before I'd be more interested. All right, let's see. We got some other stocks in the news, and I'm going to pull all of these up on this relative chart. Yesterday, Macy's warned and had one of its worst days in years, dropping 17%. And when you look at it, not really that shocking. You can see overall the broadline retailers had been weakening. You can see the trend line here that's being tested right now. Looks like it's starting to roll back over. But even though the group has been weak, Macy's has kind of gone along for the ride. It hasn't necessarily been the worst performer, but it hasn't been the best either. And as a result, we did get the warning. Stock now falling to new lows relative to the S&P 500, relative lows that we haven't seen since back in March of 2018. And the group overall has been struggling versus the S&P since that top in September. So nice little rally off of that December low. So the money has been rotating back in, but still a lot of work to do here on broadline retailers. Also yesterday, American Airlines warned, AAL. And this stock, you can see, has been a very, very weak performer for a long time. A lot of it apparently was built in. We gapped down heavy volume, but we didn't lose support. So that tells me the market was expecting some really bad stuff. And it's maybe a sell on rumor, buy on news type of thing. After the open yesterday, the stock's risen. But this is not a very good performer. You take a look at the overall airlines. Yes, they've been weak, but AAL has been one of the worst performers. And that shows up here in this relative chart. Underperformer versus the S&P 500. And over the course of the last 6 weeks or so, airlines have been very, very weak relative to the S&P. So a lot of issues there. Now, I mentioned earlier, these warnings can come in both directions. It's not just negative warnings. Sometimes you get positive warnings. And a couple of those this morning, PVH, they pre-announced results above estimates. And this one was kind of interesting because the stock overall has been so weak. So it's getting a nice recovery, but it's only getting back up to where it broke down from. I don't know. This one relative to the clothing and accessories group, which has been under a lot of pressure, has not been performing well. I mean, this has been one of the weaker performers. Yes, today is giving it a pop, but if it fails at the 50-day and fails at price resistance, I'd be careful because obviously a lot of folks have been selling this stock as the relative weakness would indicate. Next up, Ollie's. This I had mentioned several months ago about this being one of the best stocks in the broadline retail group, even better than Amazon. And the stock went through a really rough December with the overall market. Prior to that, it was actually holding up pretty well. Well, today they came out and they raised their fiscal year 18 revenue and earnings per share estimate. They came in with their holiday comps, which were 7.1% higher, and their total sales were up 16.6% versus the same period last year. So really good news, gapped up. I think it's filling a gap. This is one that I think could turn back around today. I would not be surprised to see some buyers come back in now that it's filled the gap from the earlier massive gap up. Volume pretty heavy today, is going to be the heaviest probably since back in early December. We'll see whether or not we get that strength in the afternoon. That would bode well for the stock. This is what I was referring to, though. Just 2 months ago, 2.5 months ago, this stock relative to the broadline retailers was absolutely soaring, clearly outperforming the S&P 500. So you got to wonder maybe if this pre-announcement, this upside pre-announcement, can get Ollie's back on track. Netflix upgraded yesterday after the bell by both UBS and Raymond James. This comes on the heels of a really strong rally. The stock now up 110 points or close to 50% in the past 2 or 3 weeks. This has been one of the best performers coming off of that December 26 bottom. Netflix not showing any signs. Very surprising to me. I thought the stock might show a little bit more relative weakness, especially after this run, but the move to the upside continues. Also, General Motors raised guidance for fiscal year 18 earnings per share and for fiscal year 19. Not a big fan of the autos. If you go back over the last 10 years or so, I talked about this yesterday. Autos have, except for maybe Tesla, most of the autos have just been real underperformers versus the S&P. But GM is getting a nice pop this morning. We'll see if we can go up and negotiate this gap resistance up just shy of $39. If we can get back close above 39, then we'll have a chance to run for that $44 level in June. And last one I wanted to go over was Chico, CHS. They announced that they're going to close 250 or more stores in the U.S. over the next 3 years. The stock had a double top in April and May around 10.5, and just recently, within 6 months, had fallen back to 4.5. That tells you, again, the stock market looks ahead. It knew this was coming. We're getting a little bit of a bounce today with this news, but I think we're going to struggle to get through 6.5. One last comment, and this will transition nicely for you, Mary Ellen, but Tilray, TLRY, their lockup expires next week, and one of the big holders said that they will not register their shares and sell based on that lockup expiring. But I know you wanted to talk about a number of cannabis stocks. What do you got for us today?
Yeah, actually, I'm going to be reviewing going into this January period and beyond. We're going to start seeing Q4 earnings results from some of the Canadian listed cannabis related companies. And it's with great anticipation. There's not a lot in the way of huge expectations quite yet. We're still super early in the cycle with these industries, but there's enough going on that I did want to go ahead and review some of the stocks out there that are being highlighted as ones that at the very least, investors should be aware of. A couple of factors are coming into play here. And of course, we've seen a number of not quite merger activity, but certainly partnerships with some of the larger U.S. beverage and tobacco firms reaching into the Canadian marketplace. And that's lending a little bit of credibility to some of these cannabis firms, so that there is an anticipation that at some point, again, certainly not over the near term as far as seeing positive fundamental results, but we will expect to see continued vibrancy. It's an area that has a lot of investors' interest. In fact, we're seeing a huge ramp up in capitalization as far as pre-IPO capital flooding a lot of these bigger companies. So it really, for those of you that have been on the sidelines, rightfully so, but there is a lot of activity going on that, again, is providing a bit more in the way of validity. So we can start here with Tilray. And for those of you not familiar, this is a Canadian based marijuana firm. And the stock was the first to IPO on a major US exchange. And so they are listed. And in fact, last week, or actually earlier this week, Piper Jaffray's analyst went ahead and put Tilray at an overweight. He has a $90 price target, and we've quickly blown through that. We're at 98 right now, but he does have the stock as an overweight, and he's talking about the firms. They have a relationship with Anheuser-Budweiser, and then also with Novartis, NVS, and that's with the medical marijuana side of things. And so Piper Jaffray thinks that this company is well positioned given its medical brand as well as beverage partnerships. So this is certainly one firm that you can keep in mind. And then another one that's also well known is Cronos, C-R-O-N is the ticker symbol. And this is another stock. It became a game changer back in, let me just go ahead and get that ticker up here. Back in last February, the stock became the first marijuana stock to uplist from over the counter to the NASDAQ. And we can see really the pickup here in the stock. It's up another 6% today. And let's go ahead and take a look at the weekly on this particular stock. And we can see that for the week, we are up rather significantly, 17%. But more importantly, from my work, when I look at stocks, I like to see stocks coming out of what are called bases. And we can see this stock did hit a near-term high back in December, and we are very quickly closing in on that, and in essence breaking out of a base. We're looking at a daily price chart. We can see the RSI is trending positively, and take a look at that MACD. It had that positive crossover, and actually I'm wondering if I'm running out of time, but we can take a look at just a couple more stocks, and this is something that I can go forward as far as covering areas in this industry that, again, do have something in the way of validity, whether it is because they're partnering with other firms or because they actually have revenues in place. One name is NBEV. We'll close it with this. And this particular stock is New Age Beverage, and they are now going to be able to introduce new beverages with CBD drinks in 2019. And a lot of that has to do with the farm bill that Trump passed into law December 20th that allows for hemp as an agricultural commodity is now going to be able to be produced, and NBEV is going to take advantage of that. This is another one where an analyst on Wall Street is bullish. He upped his price target from $6 to $8. We're now at 6.31, and the company, there's a lot of other dynamics going on as far as they're partnering with other beverage firms globally. So I will leave it at that. And again, going forward, there's just quite a bit more that we can certainly cover and touch on. But this week, why don't I go ahead and move right into the what's hot and what's not. And Tom and I, we alluded to this earlier, the fact that realistically, when trying to review what was not hot this week, and by that I mean which stocks were down, and quite honestly, there were only, certainly less than 25. I mean, it's just unparalleled as far as what we're seeing in the markets this week as far as upside action. And the sense there is that not only are fundamentally sound and strong stocks getting bought, but there's a lot in the way of bottom fishing, stocks that really sold off tremendously from that October through the end of December period. Investors coming in and thinking perhaps they've gotten cheap enough, so they're scooping them up. But let's go ahead and get started. Lots to cover on the what's hot and what's not. And what we're going to go ahead and start with today is some of these energy stocks. And Tom did touch upon this as well, the fact that oil prices have really rebounded here. And if we take a look at this peak in oil prices back in October into the December lows, that is a well over 40% drop in oil prices. Very, very dramatic, and also very really hard for a lot of these smaller oil firms to kind of digest that. But here more recently, we're seeing oil prices today touching 52.5. And I will tell you that $50 level is rather significant. And the primary reason is certainly within the fracking industry. They do need to see at least a $50 per barrel pricing before they can be profitable with their work. So let's take a look at some of the companies that are really up the most this week, and we can review some of the drillers. We'll start there. This is Hemmerlich Payne, HP. We're looking at a daily price chart. And this, I will tell you, this week, there is a Goldman Sachs had their Global Energy Conference on Tuesday and Wednesday, January 8th and 9th. And a lot of the presenters at that conference were some of the bigger movers this week. So we can see how HP pretty much fell out of bed. This is in line with that drop in oil prices. It is picking up a bit here. So what we're seeing is a downtrend reversal in the sense that the price broke up above this 10-day simple moving average, this green line. But the RSI, we're looking at a daily price chart. It's not quite positive. It just very closely got there. The MACD, we had this positive crossover black line up through the red, but it's not quite up above that net neutral zero. And what we're going to be paying attention to here is how this stock behaves at this downward trending 50-day simple moving average, which is at $57. The stock is currently at 53. So there's clear anticipation from my work that we will hit resistance. And we've already had a very significant advance from this 42 to 53. So the stock at the very least is due a pause. Let's take a look at another one of these drillers. PTEN is Patterson Energy, and a very similar phenom, but the difference here is Patterson really started to deteriorate back here in May, well before the decline in oil pricing. So the impact has been more, taking a look just at this, could very well be fundamentally driven as well as the price of oil. But we did have a similar spike here from this turn on the bottom, another one where anticipation is big as far as resistance here at this downward trending 50-day simple moving average. Quite simply, just go back historically and you can see here this attempt rally in October prior to the decline in oil, and it did fail at that 50-day simple moving average. Let's take a look at a couple more in this space just to give you an idea of what to be on the prowl for. This is APY, kind of a smaller driller, but what I did want to point out to you here is another company that had a downtrend reversal, and take a look. It just about touched that 50-day before pulling back, and that's the phenomenon that I would anticipate seeing in a number of these energy price oil stocks. We can take a look at a stock that actually has broken above that 50-day simple moving average, and with the reason that it would have more room to advance, and it is kind of dancing with that 50-day right now, but 2 days ago it did appear to break above it. This is Precision Drilling. PDS is the ticker symbol, and the stock is up 11.5% for the week, and we can see it's just now poised to break above. What I like about it is the RSI is positive, up above this net neutral zero. Your MACD had that positive crossover, but it's poised to turn positive here. So should we see a more clear-cut break above that 50, you could very well see a further advance up to that 200-day. Now, this is a very low-priced stock. It's $2, could trade up to $3. Normally not an area that I traffic in. I tend to like stocks $5 and above, but this is more for educational and example purposes. And so we can see how these energy stocks are in line with that uptick in oil prices and are starting to move ahead. One other stock that we can look at before moving on to another area is North American. This is a Canadian energy stock. NOA is the ticker symbol. It's a 300 million market cap, but it's up 13% on the week. And what I like is the fact that it is well above any of these key simple moving averages, continuing to form the right side of its base, and it's with an eye toward potentially breaking out. We're looking at a daily price chart. Your RSI is well above this net neutral, and then your MACD is also in positive territory. So this is certainly a more constructive name within these beaten down energy stocks. Let's go ahead and move to the next area. And I know Tom talked about this as well, and that is consumer cyclical, consumer related stocks. And there have been a number of areas that are really responding constructively this week. And a lot of it has to do with not only recent earnings and sales reports from the holiday season. We are also seeing a pickup in these former leadership names that got thrown out with the bathwater when the markets corrected. So let's take a look at some of the retail discounters. The first one that we can take a look at is Five Below. FIVE is the ticker symbol. This is a company where the items that are in there are priced $5 or below. Their market space is geared toward teenagers, college students. And what we are looking at here, I wanted to point out to you, these gaps up back in 2018 are all earnings driven. This is a superior company as far as fundamentals. Their earnings and sales are in place. Take a look at this drop here. Consumer cyclicals started dropping before the broader markets in September, and it fell out of bed again in line with the broader markets. But here more recently, it has picked up significantly. This week, the stock's up 11.5%. And what we can view here is the stock has broken above these key simple moving average. It's continuing to form the right side of this base with an eye toward breaking out of that base. We can see the RSI is positive. The MACD turned positive and is now up in positive territory above that net neutral zero. So this is certainly one of the stronger names within that discount retailing space. We can also look at DG, that's Dollar General. This is a company that had an upgrade earlier this week. The stock's up 7%. And another one that is poised to break out of this base. And what I'm pointing out to you within these retailers are those stocks that were winners last year. And the reason certainly they were winners is because they were very fundamentally sound. And the anticipation is that they will continue to grow their earnings and sales going into next year. We can take a look at one other one in this discounting retail space, and that is Dollar Tree, DLTR. And this particular stock is not up quite as much. It's up about 4%, but there's a lot going on in the way of activists have taken over the board, and they are suggesting a lot of changes for Dollar Tree. They want them to change and sell part of the company. So the company stock did originally gap up earlier in the week, but now as analysts are digesting the activist comments and their suggestions, the stock is pulling back a little. But it is certainly in a confirmed uptrend. So those are areas certainly in the retail. We can go ahead and move on quickly and take a look at some of the retail restaurant stocks. And again, I'm going to be favoring and pointing out those stocks that performed well last year. This is Wingstop, WING, and we can see these gaps up here are very much on strong earnings. This is a company that has managed to grow not only their US based, but they're also going global. And there's a lot in the way of growth activity taking place. We can see the stock is poised to break out of this nice 2-month base here. And we're looking at a daily price chart. That RSI is trending positively. And the MACD also, after having that positive crossover, is now in positive territory. So this is a very, very constructive, positive looking chart, because you also want to pay attention to the volume as it's poising this breakout point, and we are getting some very nice volume. One one within this that we can take a look at is CMG. This is Chipotle, and for those of you following the markets closely, you may know that they had great difficulties 2 years ago with their Ebola, or with their bacterial breakout, but they've really managed to turn things around, and we can see this gap up here earlier this year on earnings. The stock did come out again with earnings very recently that were viewed very constructively. The stock is poised to hit a new high in price here, and analysts are really bullish. The stock is up 12% this week. It's trading at about 510. Analysts have a price target of $550 for this stock. They've had 2 Wall Street upgrades this week, and they're citing reduced cost as well as expansion. Chipotle is going to be opening new stores. So that is certainly some of the retailers. And one last area in retailer is home furnishings. This was another area that was super hot last week. We're starting to see renewed traction. This is Restoration Hardware. RH is the ticker symbol. Not quite as dynamic as some of these other companies that we have been looking at here, but it is up 12% for the week, and analysts are looking for 175% earnings growth for 2019 for this stock. So very vibrant, but again, not quite as active as some of the other ones and quite as constructive that we've seen. I'll show you a large cap name that can be put into this grouping. This is Home Depot. They do have a lot in the way of home furnishings as well as other areas, and this stock is trying to turn. It's only up about 3% this week. It still has work to do as far as breaking above these key 200-day simple moving averages, but one to keep an eye on. We can see the MACD trending positively, RSI up above that net neutral zero. So for those of you that favor some of these larger, better known name, you may want to go ahead and put that on your watch list. Moving on, we can take a look at technology stocks, another super strong area, not overall, but certainly pockets, and that would be computer software software. So we don't have time to go over all of the names, but I will tell you computer software enterprise. This is a similar area where stocks that were doing really well last year are being reignited and refavored. Again, all because of the fundamentals. These stocks, this is TEAM, Atlassian, and this is a company that was a big winner back in 2018, and we can see again where it is picking up here with the broader markets. And we have time to take a look at one other stock that really is a bellwether within these computer software enterprise. This is Salesforce, and the stock is in fact up about 7% for the week. But again, another big winner back here in 2018. So really what we're seeing this week in the broader markets are two different dynamics. And one is we're seeing these former leadership stocks come back into favor. These are stocks, again, that have very sound, strong earnings and sales. And the other phenomenon is in the way of bottom. Take a look at stocks that were down and out, and people think that perhaps the bad news is already written into those stocks. So let's go ahead. I'm going to move on to healthcare as another area that has quite a bit in the way of strength, and a lot of that has to do with biotech stocks. And of course, last week we had the Bristol Myers buyout, and that was really quite a Bristol Myers purchased Celgene. I'm trying to get this, and I apologize because that stock's not picking up, but we can certainly look at other bellwether biotech stocks to get a feel for what is going on there. But Amgen is another stock. Let me see why this is not working for me right now. Yeah, so super. Here's Amgen, and we can see that the stock has picked up in line. This is another area, healthcare, where there is a very huge medical conference that's going on in San Francisco this week. The JP Morgan, it's an annual event, and honestly, year after year, this particular week, you will see a lot of medical and healthcare stocks really go charge forward. Amgen, a lot of the bigger pharmas came out and talked about M&A activity similar to Bristol Myers' purchase of Celgene. There's anticipation that we're going to see more in the way of M&A activity there. And I can go on and on with other companies that are really doing well this week. And a lot of them, again, are going to be those big winners from last year. This is BEAT, Biotelemetry, and another one. They were presenters at the JP Morgan conference. Analysts like what they heard, bid the stock up. And we can also take a look at other stocks, certainly. MEDP is another one, MedSpace, another former leader. It's up 14% this week. And so what we would like to see here, of course, is the stock ideally reach back up to this mid-December peak in price and break out of a base. Now, most certainly the stock has seen quite a bit in the way of an advance. It's up 14% so far this week. I wouldn't anticipating it happening right away. We very well may see a little bit of a pause here, whether it's broader market related or stock specific, given this big advance. But at some point in time, if we were to break out, we would be breaking out of a much longer term base, which would really be quite constructive for this particular stock. And then one last name in this area is another big winner from last year, and we can move on to different areas. TNDM, this is Tandem, huge stock last year, up over 1,000%. And this is a stock that's involved with infusion pumping for diabetics, and we can see that it is regaining its traction here, again, with the broader markets. And this is super, probably one of the best looking within medical, because we can see that it really held in quite well. It did not get down and out like a lot of other stocks with the broader markets. It's held in firmly. If we can see this stock break out, it could indeed advance further, provided that the broader markets do as well. So without drilling down that are also hot this week, transportation stocks, we saw rail and trucking stocks pick up quite a bit. that is actually constructive for the broader markets because, again, these a lot, particularly within the rail stocks, we can look at CSX is a bellwether name there, and this is CSX Corp. We can see the stock is having a nice advance here. A lot of the rail upticks have to do with the increase in the pickup in potential oil activity. They transport a lot in the way of oil, but we also saw upticks in trucking. And so you do like to see this. Oftentimes these transports are pointing toward the potential expansion of the economy, the need to move purchased goods. So that was another strong area last week. And then lastly, on the strong side, financials overall were not particularly strong, but there was an area that did pick up this recent week, and that's these payment processors. We're looking at a company, SQ Square. For those of you not familiar, this is a company that allows individuals to purchase using a mobile device. Restaurants are adopting this quite a bit more. So we can see the stock is turning. We're not quite there yet as far as the stock being technically attractive. Ideally, if it breaks back above this 200-day simple moving average. We do have the other components, however, with the RSI up above this dashed net neutral trending upward. And then the MACD also had this positive crossover. We're not quite up above that net neutral yet, so it does still have a bit more in the way of work, but it's certainly one that I would keep on your radar. These mobile payments and then also payment processors that are making it easier, less costly for companies to process payments have been super strong within the financial space. So now we can go ahead and take a few minutes and talk about what is not hot this week. And as I said before, it's not going to be a very robust group, but it is going to be one that is an area that is down for sound reasonings. And Tom talked about this with some of these companies coming out with holiday sales that were not so robust. This is Macy's, ticker symbol M. We can see this big gap down here yesterday in response to their lackluster holiday sales reporting. So the stock is continuing its decline. It's down a little bit more today, but we can see that these negative indicators are turning downward. And oftentimes when you're viewing stocks such as this, if you have not gotten out of the stock and you're looking to potentially plan your exit, you can go ahead and drill down and take a look at potentially an intraday chart. And this is showing us quite clearly this big gap down. So we can see that the stock is oversold, and that's with an anticipation at some point that the stock could have a little bit of a bounce. But overall, it appears that this downside negative action is going to be dominating the stock's activity over the near term. And then other retailers also that responded not only to their poor news, but also had bad news of their own. This is KSS Kohl's, the department store. And this is another one, and it's actually rebounding a bit today, but the stock dropped yesterday in tandem with Macy's news. So we are seeing a little bit of a bounce today. It's up 2%. Other retailers that are really lagging, not doing quite as well. Walmart is one. The stock is not quite down for the week, but it's not really up. It's just trending sideways. It's not moving in line with a broader market that is seeing a lot of stocks popping quite significantly this week. Target, now interestingly, it's up 2% today, but certainly at yesterday's close, it had dropped yesterday. And again, another stock that is more marking time than really advancing in line with the broader market. So let's take a look at some consumer staple stocks that are not doing well this week. The first one I'll point you toward is HELE. This is Helen of Troy. They actually came out with numbers yesterday that actually it appears to be a few days ago they came out with numbers. The numbers were actually in line with estimates, but they trimmed their outlook going forward, and analysts did not like that. The stock dropped in line with that. Another company in this same space is Estee Lauder, the cosmetics. This is a company that really has struggled of late, and this gap down here is in line with Wells Fargo analysts downgrading the outlook for this cosmetics company. And so those are a couple of consumer staples. Another consumer staple stock that is not performing well this week is Philip Morris. This is another downgrade. Cohen came out, downgraded the stock. They cited their reasoning as cigarette sales are down, and they're anticipating that that to be a trend going forward. Stifel, another Wall Street analyst firm, also downgraded Philip Morris, but we can see that the stock is trying to potentially reverse this downtrend, but it certainly has headwinds going forward. And also there was price target declines on Philip Morris from 70 down to $59, and the stock currently is trading at 69, so that's going to make it difficult as well. One other area that is not doing well of late, and that is the apparel manufacturing space. We can take a look at Ralph Lauren as an example. We can see that it is trying to turn. I can go ahead and pull up the weekly to give you a bit more in the way of tuning in. And the stock is up about 2% for the week. And a lot of these apparel manufacturers are going to have a tough go because the Chinese tariffs, a lot of their manufacturing does take place over in China. And there's an anticipation that they will be negatively impacted by these Chinese tariffs. So that is a space that is not performing this well. And then lastly, need to take a look at some of these financial stocks. Let's go ahead and take a look at the XLF financial ETF to begin. And we can see that this group is up 1% so far this week. And that's as compared to a number of other sectors that are up quite a bit more, anywhere from 3% on up. So the financials are struggling. And one of the primary reasons is because a number of these bank stocks are just not doing well. Let's take a look at some of these bigger bellwether bank stocks. We can take a look at Bank of America, and we can see for the week it's up 1.5%, but we're not getting a lot of dynamic movement here. We can see that this MACD just about trying to turn before even eventually getting positive. And so one of the dynamics going on with these bigger banking names is they're poised to present their Q1 earnings, not next week, but into the beginning of the following week. This is JP Morgan. It's down 0.75% this week. And certainly that first quarter, Q4 earnings is going to be really closely watched because it's with an eye toward these financials potentially having a good year or not. Is loan demand there? Is the flat yield curve impacting these bank stocks? Here's Wells Fargo. It's down actually flat for the week. And so that said, there are some areas within banking that are picking up, for lack of a better word. We can take a look at EWBC. This is East West Bancorp, a Southwest. They're actually more on the West Coast. This is more in line with the dynamics that we're seeing in some of these more regional banks, where they have fallen just so out of bed, so to speak, down over 24% from its peak in price. But over the last 3 weeks, we are seeing a downtrend reversal attempt. And again, fairly typical of some of these larger super regional type banks, but we're not quite there yet. Take a look at this MACD. We haven't quite had that positive crossover, the black line up through the red. We're not even close to getting up through this area of neutrality up into positive territory. And then your RSI, it's trending upward, but we're not quite up above that neutral area. This is a weekly price chart. We can drill down to the daily, potentially get a little bit more of a positive picture. But again, I think the reporting from these larger banks are really going to set the pace for some of these other regional outliers that are attempting to reverse. This is a daily view of that EWBC, just touching up upon this 50-day. We can see where it's been met with resistance at these many other downtrend reversal attempts, failing at that 50. So we'll, of course, keep an eye on how this particular stock fares at that particular 50-day simple moving average. And we can look at any number of these regional banks that are really trying to turn. This is one of the first areas to go into bear market territory after dropping over 20%. And they are attempting to reverse. Of course, we would like to see bank stocks participate in the broader markets. It's a bullish indicator as far as the broader markets from there. So I'm going to go ahead and leave it at that. Tom, I know we covered a fair amount. I could have gone on endlessly on the positive side.
Yeah, I would say, looking at the market overall, I'm sure you had plenty to choose from in terms of the what's hot this week, and what's not's a little bit more challenging for sure. But it's amazing how many stocks you get through in such a short period of time. I mean, 30 minutes is not easy to get through all the number of stocks, and not only looking at the charts, but a lot of fundamental information that you throw in there as well. So very much appreciated by everyone, I'm sure.
Super.
All right. Well, we are now going to move into the 10 in 10. And this is, if you're new to the show, this is just simply a segment where Mary Ellen's going to give me 10 stocks, and I'm going to get through them as quickly as I can, but I'm going to annotate them. I'm going to show you how you can use the tools here at StockCharts just to give you quick reminders of, different levels to look for. Maybe it's a trend line, maybe it's a moving average, maybe it's, just a horizontal price support resistance line. We love using those on the show. But just something to kind of trigger things that you need to be aware of on that particular chart. Then you can save them into your chart list, which is really cool. Great feature, great way to organize your trading activity. So I'm going to go ahead and start. I know with the first stock of the day, which is, we said earlier, was Dow DuPont, DWDP. So let me go ahead and show you that chart. So here we go. Dow DuPont, first of all, it's obviously not bounced the way many other stocks in the market have. We've still got a lot of question marks on this chart. I did point out here that the PPO has now gotten back to the center line. And you can see over the last 3.5 months, almost 4 months, that has been a problem. It's really difficult, if not impossible, to begin strengthening on the chart unless you have a PPO or a MACD. I know Mary Ellen likes to use MACD. Aaron uses PMO. It doesn't matter which oscillator you use. You want to see it above the center line because that's telling you that the strength is building. Short-term versus longer-term moving averages are moving in the right direction. So here, that's the good news. We have finally moved into positive territory. The bad news is I still think there's some overhead price resistance that we need to negotiate. Off of the big selling to start the first quarter back in October, we bounced. And notice after gapping up here in early November, we came down and we printed this low around 56, got up to 60, came back down, held 56, went up to 60, came back down to 56. And then eventually you can see the volume really picked up in December when the overall market sold off and Dow DuPont lost that 56 level. Now you look forward here, and the last 4 days we've had a really nice rally. You can see that we were oversold. But now if this downtrend continues, something you want to watch for in a downtrend, RSI tends to kind of struggle when it gets up into that 50-60 area. And a lot of times that's when you see stocks roll over. So here you can see Dow DuPont struggling at $56. In order for me to get a little bit more bullish the stock in the near term, we've got to get through $56. That has proven in the past to be support. When you break down, that then becomes resistance, and that is holding the stock back right now. So Dow DuPont, to me, is nothing more than a neutral at best. I don't think you've got an outperformer here. If it can break through 60, then I think you've got a shot, break through 56, then I think you've got a shot to get up to 60. But until then, I would probably be a little cautious here with Dow DuPont.
All right. The next one is SH, an index fund.
Okay. And this one, by the way, was the most popular in the chat room today. So I'm going to follow up with that. Yeah, we've talked about the SH before. Now, in retirement accounts, you can't short, but you can buy ETFs that short, and that's what the SH does. So if you believe that the S&P 500 is going to go lower, you can buy the SH, and the SH will increase in value to the extent that the S&P 500 moves lower. So it's an inverse ETF. So you don't have to short the SH. You just buy the SH, and your account or your trade will gain value if the S&P goes lower. Now you can see that with the recent rally in the S&P 500, the SH has been coming down. It goes opposite. So it's pulled back to a level that I think is pretty important. And I've talked about the SH before on the show, and I've said as it gets closer to 30, I think your reward to risk gets better and better. The S&P 500 is coming up underneath, trying to test some overhead resistance. 2581 was a big level. Still got the 20-week moving average, which is all the way up at, I don't know, 2660 or so. Those are going to be the two big levels, in my view, coming off of that bottom on the S&P at 2350. So as we pull back on the SH, I actually like the trade, but I'd keep my stop in play. I'm still pretty bullish the market down the road. I do not want to get into the SH and just hold no matter what. I want to see a reversal pretty soon. Another way to maybe play the SH is to simply wait for a reversing candle on the S&P 500. You'll buy it this a little bit higher, but that might at least give you the satisfaction that the market is beginning to roll over. And then I would kind of try to keep probably a pretty tight stop. I think a move below $30, especially a close below 30, and I'd certainly reevaluate my position here.
All right. The next one is Adobe Systems, ADBE.
Yeah, I cheated a little bit. I've already annotated a few of these, but I'll show you how to annotate some of the others as we go forward. The thing I looked at on Adobe, Adobe's a great company, been around a long time. Pullbacks in just like in many great companies, these pullbacks generally represent good buying opportunities. Now, Adobe did go down just a little bit below that November low, but I'm going to call this a double bottom. And you can see the recent reaction highs up here at about 260. I think we're sitting in the middle of a pretty wide range on Adobe. One problem I have with the stock is that even though software has been going down overall for the last 3 months, you can see Adobe topped relative to its peers back many, many months ago, back in June, and has been downtrending. So I really like the software space, especially if the market keeps going higher. But I think there are other plays that might be better in the software space until we see Adobe start to pick back up again on a relative basis. So I've annotated this relative resistance line here on Adobe. This is relative to its peers in software. You've got the double bottom in. We're sitting in this range, very similar to what I just talked about in terms of price. But I want to get a stock in software that is one of the leaders. So let's get this relative breakout on Adobe. And if it were to move back down, but it just simply moves back down slower than software, what you could see is Adobe get back down closer to this price support area and see its relative strength actually break out. And that, to me, I think would be pretty bullish as it approaches support. Something to consider if the market rolls over again.
And Tom, I couldn't agree with you more about your Adobe. Yeah, definitely seek the leaders. Yep. Next one is KEYS, Keysight Technologies.
Okay, now I'm back to not cheating anymore. All right, Keysight Technology, really nice move here. Getting back, it looks to me like it's going to head up and test this gap resistance area between 69.70. That's what I would look for. When you look at it relative to its peers, this is what I think Mary Ellen was just referring to, what I was talking about. Here's a leader amongst its peers. KEYS has been performing very well. The group overall has been downtrending, and yet this stock is up near its 52-week high. So what I would do is if you get the stock or the individual group breaking out, and you've got the stock that also makes a breakout, I think that would be a very bullish combination and development as we go forward into 2019. So this one I'd keep on my radar. Now, would I buy it at 67? No, because I like support down here at price support, 62 and change. Your 20-day moving average is sitting down here. So if I think it has the potential of moving down $5 and I'm looking at it with the potential of moving up $2, I don't like the reward to risk at this point. But if the stock were to pull back to 62, then I've got about 10% upside, I can keep a fairly tight stop below that 20-day and below price support, then I like the trade better. So I think this is a nice looking chart. I simply would wait and see if you can get it down the road when the reward to risk makes more sense.
Okay, the next one is M&K, Mallinckrodt.
I think that's pharma, isn't it?
Yeah.
Yep, pharmaceutical. Yeah, the stock had been under pressure. That surprised me after this big gap up and move. I thought when it came down here and put these bottoms in at gap support that was going to hold, and the stock looked like it was going to make a run. Then, of course, with the overall market selling off, the stock lost its luster. Now it's coming back though. Volume was okay. Got through the 20. So I think what I would do with this stock, because I do think healthcare, pharmas, especially if the market rolls over, we could see relative strength from many areas of healthcare, and in particular the pharmas. So I would be watching this stock. I think if it's, getting back up through the 20 is a good thing. If it can hold the 20, it's even a better thing. So a pullback to test the 20 would be an area that I would consider entry. And then I just want to make sure it holds, because in a bad market, if you're below that 20-day moving average, I really don't want to touch it from a long perspective. So let's see if that 19 area holds on a pullback.
All righty. Next one is LB, Lucky Brands.
All right, LB. And I did mention this one, I think, yesterday when I was talking about the retailers, because I think that their sales or their holiday sales maybe weren't quite as expected. You can see the gap down, but it did react, come back up. And I think their the main company there is Victoria's Secret with L Brands.
Oh, you're right. Pardon my misnomer. You're right. You're absolutely right.
Okay, I thought you were just making.
Sorry about that. No,
you're making a little pun.
No,
Brands because it bounced back off the selling yesterday.
Sorry about that.
Oh no, you're fine.
Yeah.
You're fine. It did break down at the end of December, but what wasn't breaking down at the end of December? So I'm going to give it a little bit of a pass. Here was the breakdown I was referring to. So right when the overall market baby was going out with the bathwater kind of a thing, the stock did break down, but it's come back up. The bad news is it went through the 20 and didn't hold it. So I'm going to say right now it's kind of in this range. We've got a reaction high up near 29. I'm going to drag this support level now down to that low that we saw in December. And you can see with the selling yesterday, we almost went right down to that level. So let's use 24.5 as support, maybe 29.25 resistance. Let's see which way this stock breaks out of it. If it breaks to the downside, I would steer clear.
All right. Yeah, they're having a tough go of it. BA, Boeing.
Oh, okay. Boeing. Let's see. Boeing, another great long-term company. But let's see what the short term's looking like. Of course, rallying with the market. Keep in mind, though, we've seen the rally in early November followed by a steep drop. We saw a huge run in late November to early December, followed by a steep drop. Now we're getting another run. If the market moves lower and we do top and go lower, Boeing is certainly not immune to that movement to the downside. Boeing, though, is performing very well relative to its peers. So you've got a leader in the space. You've also got a leader relative to the S&P. It is breaking out to a new relative high. So that's good. The problem is aerospace. Aerospace is struggling relative to the S&P 500. So until we get the group going higher, I think it's going to make it a little bit more difficult for Boeing. But let me annotate. I think the recent price high is going to be one to keep an eye on. I'm just going to draw the line up here at about 370. That's where you see the top November. We almost got there on the gap up in December. It seems like if the market stays strong, we have a good chance to make another run for 370. But can we get through? And in the meantime, if the market rolls over, volatility begins to pick up, I think this double bottom could come into play down the road, something to at least keep in mind. For now, Boeing trades toward the top end of the range, and I would just be cautious. I do like the relative outperformance versus the aerospace group as a whole, but still got some work to do technically on an absolute basis.
And then McDonald's, MCD.
All right, McDonald's. I know they bounced right off of support right here. When I get a good earnings report and a gap up and it's heavy volume and you got a hollow candle like this, I don't look for a test of the bottom of gap. I always look for a test of the top of gap support. So here on McDonald's, I'll make this one pretty quick. I thought that the key level of support right there held beautifully. We've come back up. We're above the moving average. So far, we're holding it. And again, as long as this 20-day moving average holds like that, I'm bullish. I think we could make a run toward the recent high up at 190. But if we fail to hold the 20 and the market rolls over, don't be shocked if McDonald's doesn't come back down and test that 170 level again.
And then Workday, WDAY.
Yeah, I think this is a software stock, and now we're going to look at one of them that's a relative leader.
Yeah.
Yeah, Workday had, or at least it was a week ago. Yeah, it's trying to make the breakout. And again, here you can see software moving down. You remember that Adobe chart where its relative strength topped back in June has been downtrending. Now take a look at Workday. So what Mary Ellen and I were referring to earlier, you want to stick with some of the leaders. Workday is one of the leaders in the software space. The only problem is right now, on a short-term basis, we're right up against price resistance. So here was the recent high on a closing basis, right at about 169. Today's high, 169 and change. Currently 167. I don't like buying stocks right at resistance. If I'm going to buy it, I'd rather buy it $1 later and see it get through, or a couple dollars later in this case. See it get through, get above that 170 level, get some volume coming in. Otherwise, I think pullbacks down to, say, the 20-day. You can see right here, that was a nice little pullback to the 20-day and a bounce back off of it. And off of this uptrend, what we could see is another pullback and maybe an ascending triangle starts to form. I don't know, but I do know that Workday has been one of the better relative performers in software. I like the stock. I would just try to get it on a pullback.
Okay. And then ATVI, Activision.
Okay. And by the way, with Workday, if I owned it, I'd hold it. Now, from a short-term perspective, you could be a trader at resistance, but I like the stock. I mean, this is a stock that's done very well. What was the last one? Activision?
Yeah, ATVI.
Yeah, I don't know if you have it. I think they were in the news this morning, Mary Ellen. Were they in the news? They have something going on today?
I can take a look.
Why don't you look at that while I'm looking at the chart? I think for now, it's gone down and tested the recent bottom. This, of course, is in the internet space. I'm not a big fan of internet in general, just because you can see here on an absolute basis, it still hasn't turned. We keep putting in these lower lows, lower highs, and even this high on internet's below the prior one is starting to roll over again. So I'm a little nervous about internet stocks, and so I'm not going to be a big fan of stocks within this space, especially Facebook. But I've talked about them enough, so I'm not going to throw them under the bus again today. But I would be looking for, at least in the short term, this trading range on Activision. But if it loses, say, $43.50, $44 to the downside, I'd be real careful because it's been in a downtrend, and that would just be a continuation move after moving lower, sideways consolidating. What you don't want to see is another big volume breakdown. So watch for that. Otherwise, if you wanted to take a shot on a double bottom, you could do that, but I'd keep my stops in play. I think this downtrend is telling us something about their upcoming earnings report.
Yeah, and what happened is they parted ways with a game publisher, a game called Destiny, and they split with the studio, and the stock's responding.
Okay, that makes sense. I knew I saw them as I went through all the news stories today. I just couldn't remember what they had posted. I didn't remember a warning. So thanks for clarifying that. And there's our 10 and 10. You got the 10 symbols right there. Of course, our first one was DWDP, most popular SH, and then 8 others that I went through. But again, just keep in mind as we go through these charts, I like to annotate the charts and give you my thoughts on what's going on. But also keep in mind how quickly I annotate these charts and save them into my chart list so that I can go back and refer later with those comments. And a lot of times, or with those annotations, a lot of times what I do before the show is I go back and I look at yesterday's 10 and 10 before I replace yesterday's with today's and just get a sense. And a lot of times those support levels, if you look at them, they will provide you really good signals on possible reversals in one direction or the other. So keep that in mind. Okay, let's take a look at the overall market again. I'll give you that candle glance that we showed at the beginning just to see if anything has changed. And honestly, not a whole lot has changed. We're still kind of sitting. The market's being really stubborn to the upside. On the one hand, I think it's bullish. On the other, you wonder if maybe it's stalling out, maybe it's bearish. But until the market gives us a big move from this direction, it's really hard to say. But currently, Dow Jones down 72. I think when we started the show, it was down 60 or 65. S&P 500 down 5.5 at 2591. NASDAQ down 24. And the Russell 2000 actually has gone positive. So this is one slight change, is that maybe money's rotating a little bit more towards the small caps. And small caps have actually outperformed on this rally back off of the bottom. So that's continuing today. So at least we do have that theme that has been working in the market. 10-year Treasury yield down 4 basis points now, 2.69. I'll be honest, I don't like this. When I see that 10-year Treasury yield rolling over, I just wonder how much longer the market can continue pushing higher when money is rotating into Treasuries. But the flip side is you like to see the volatility index coming down. I'd love to see it get below 16, because the last two secular bear markets, 2000 to 2002 and 2007 to 2009, we never saw the VIX get below 16 until well after the bear market was over. So this, as we're coming down and now we're into the teens, for me, it's a sign I want to be short. But if this breaks down below 16 and the S&P 500 gets back up, especially above that 20-week moving average, I think we want to be careful. Consumer discretionary still hanging in there in positive territory along with the financials. Again, really nothing much has changed. Staples still up fractionally to the downside. We've still got energy lower and utilities lower. Of course, GM still performing well. The only other thing I'll do here in this update is maybe let's take a look at the sectors overall. Because yesterday, part of the problem yesterday is that the market was trying to rally. Well, it did rally, but 4 of the 5 top sectors were not the aggressive sectors. Consumer discretionary was the worst yesterday, and I believe industrials were the only aggressive sector that was among the top 5. So the market's trying to rally, but it's almost like it's swimming against the current. And that's also why I'm a little nervous about the 10-year Treasury yield dropping, because money's rotating a little bit more into defensive fashion. I want to see the S&P have a good day and see financials, consumer discretionary, technology, communication services. These are the groups I want to see having really strong days, so that it's that risk-on mentality to support a move to the upside. I'm not really seeing that right now, and that's a little bit disconcerting watching the action. But we haven't broken down, so that's a good thing. I'd continue to watch that 2548 area on the S&P 500, and that level was, let's pull up this 10-minute 5-day chart, and I'm going to just go back 7 days here. But if you look at the action, and I draw my little trusty dusty auto support resistance line, you can see, number one, that the last time we had a big selling episode back at the beginning of Tuesday, we went back and tested the prior lows here at about that 2548 level and bounced. We've seen some early weakness last 2 days, but we've been rallying back off of it. But if we were to go back down and lose this level, I think there'd be a couple of problems. Number one, the short-term support level would be giving way. But also, if I get out of this and go back to that daily chart, and here we don't really need to go back very far, but let's just do 6-month daily. You'll see that the 20-day moving average is at 2550 or 2554, actually. So if we go back down below that intraday level that I showed you at 2548, we're going to be losing that support level. But more importantly, we're going to be rolling over below the 20-day moving average. So to the downside, if you're more on the bullish side, which everybody's going to take their pick here as the market rallies, just be careful. I think if we go down below that 2548 level, you might begin to see the selling pick back up again. And that would be something that would bother me from a long perspective. Okay, anyway, that was a little bit of a lengthy update. We're going to move into our final segment of the day. And, Aaron and I and several of our guests that have been on here, we've talked about bear markets, cyclical bear markets, secular bear markets. And if you're not familiar with the term, cyclical bear market is really just it's a shorter term bear market in when we consider the number of months historically, and it's not as deep of a sell-off as we've seen in some of the secular bear markets. The 2000 to 2002 and 2007 to 2009 that was two secular bear markets where the stock market for a period of 12 years went nowhere. From 2000 to 2012, we went nowhere, and we had two bear markets in between. A cyclical bear market is more of a pullback, maybe on steroids. It's a little bit more than a pullback, but it's not a real bad bear market. But it moves down more than 20%, but it typically doesn't last long. And then the overall big picture bull market continues to push higher. So, Mary Ellen, I guess, looking at the market, by definition, we've pulled back more than 20% on the S&P at the low. So technically we're in a bear market. But does it, when you look at this, does it change your trading strategy at all? Or do you still look at those? Are you still looking for the same types of stocks doing certain things relative to moving averages and so forth? Or does the bear market, just the nature of a bear market, change what you're looking at? I just want to get your thoughts on it.
Yeah, so currently in the broader markets, I'll share my screen very briefly here, and we can take a look at the S&P 500, and I'm going to drill down to current and then kind of pull back from there. But what I'm showing you here is the S&P 500. It's a daily price chart, current, and I'm pointing out certain components as far as certainly this bear market activity that we've seen here and what I would need to see to turn more constructive. But we did have action last Friday. It's called a follow-through day. It's a system where you're looking from the lows. You need to see the index, a broader index, up at least 1.2% on volume over the prior day, which signals the reversal of a downtrend. And we did get that last Friday, making it what I call a playable rally in a bear market. So what I'm focused on now are those stocks that were leaders going into this correction. And those have been your biggest winners, your biggest bouncers. Stocks from my idea list, a number of them are up 15%, 17%. These are stocks that got thrown out, but the fundamentals are still very sound. But currently now I'm looking at this 50-day simple moving average as a possible area of resistance. I'm pointing it out here. Prior periods where it did attempt and failed, and that would be very, very near term as far as potential more upside. But bigger picture in response to whether we are in a secular bull market or not, that is actually what I do believe, that we are in a secular bull market where we have larger periods of these bull markets and then smaller bear markets. We're currently still in a bear market, but the length of time of those bear markets tends to be shorter, and the overall trend, bigger, is upward. And the reasoning for that is because relatively we still are in a very low interest rate environment. While the Fed has raised by 0.25% in December, historically, the current interest rate levels are very, very low. And we're also in a period of strong corporate earnings growth. But I think this first quarter is just going to be ever so critical, simply because for Q4, we did get just enough in the way of earnings downgrades and outlooks that were returned downward. Apple would be a prime large example, but we did see it with a number of other companies, whether retail or not, where they were suggesting a bit of a slowdown going into 2019. So whether that materializes with Q4 or whether it's more into the second quarter that those slowdowns start to become evident is going to be really quite critical. But overall, I think we are in a bear market period that is not going to be super extensive or lengthy. If that
okay, no, that's awesome.
Mm-hmm.
I agree with you. I think we're in a secular bull market, and I'll pull up a couple of charts just to kind of show everyone what I'm looking at. If you're new to the show, this will maybe be enlightening. If you've been following the show, it's probably something that you have seen before. But in my last Chart Watchers article that I wrote, this was 2019 stock market forecast, and then my report card that some forecasting that I did in 2018. You can go back and take a look at that. But the one chart that I wanted to point out is the long-term nature of the S&P 500. Now, this is a 100-year quarterly chart. I think this is fairly long-term. Certainly goes back beyond everything I'm aware of, since I've been following the market. But I think, maybe this will help to demonstrate a little bit more what the difference is between a secular bear market versus a cyclical bear market is. Here you can see the secular nature of this. This is a 12 or 13-year period from the late 1960s to the early 1980s. And you see the two huge drops, two big bear markets in here. And during the whole period, the market goes nowhere, as in total. If you can fast forward to 2000, 2012, 2013, you see almost the identical secular bear market. Two very, very large bear markets, and both followed by bull markets, started bull markets. But over the entire period from the 2000 top to finally a breakout in 2012, 2013, we went nowhere. And so it's very frustrating from a long-term buy and hold perspective, especially if you're buying and holding the S&P 500, because for a dozen years, you see nothing but torture and all of the emotion that goes along with these deep bear markets. Same thing again, back at the other level. But if you notice, the stock market tends to do really well in these secular bull markets. And this is what Mary Ellen was referring to. And I agree. I think we're in a secular bull. Here's the first one on this chart that lasts about 18 years. We had a double top in the 30s and 40s. When we broke out of that in 1951, we went up another 17, 18 years in what I consider to be a very strong uptrend. Did we go straight up? No. Was it without bear markets? No. You can see a pretty good one here in 55 or 56. Another very quick drop here in 61, 62. Another one here in 66, 67. But notice they don't go very deep. You see the difference between the depth of these secular bear markets and the depth of these cyclical bear markets within a secular bull market. Same thing once we broke out in the early 1980s. Very strong secular bull market, lasted 19 years. Yes, we had some bear markets along the way. Here was 1987 crash. I'll never forget it. I was on my honeymoon at the time. Got back and my portfolio was in a shambles. But anyhow, 1991 bear market. And you really can't see it too much, but in 1998, that was a bear market, but it doesn't last long. So when you look at this, if you believe that this is a secular bull market, you look at, 2016, we had a correction, which almost became a bear market. Didn't quite, because it didn't hit that 20% threshold, but we have hit it this time. And if you look during cyclical bear markets in prior secular bulls, this pullback right here looks kind of similar to 1998 or 1991, or maybe not quite to the extent of 1987. Even 83, 84, that's probably more of a correction. But look at it compared to these other pullbacks or, cyclical bear markets within a secular bull. I think that's what we're looking at. So for me, the question is, are we going to go back down maybe and test that recent low? Or are we going to maybe break below that recent low we saw in December temporarily before we move back higher? And so I'm going to focus in on the last two bear markets that we had within a secular bull, because I think trying to compare this bear market to these last two, I think you're comparing apples and oranges. If you truly believe this is a secular bull market, we're not going to see these kinds of bear markets that last 2 years and go down 60%. That is not what I'm looking for, 50%, whatever. So let's take a look at the last two bear markets. And this is 1998. This is a chart of 1998 S&P 500. And here was your bear market. It started in July and it ended with a double bottom in October. 90 days. Boom. Done. We went down. Things got very fearful. Look at this rally here back. 13.7%. Back into the area of prior support. So you break support. That becomes resistance. You pull back. You test that prior low. And then it's over. And you go back to the upside. Let's go back to the next one. 1991. The S&P. Now here, this looks a little bit more like, I think, 2018, where we kind of went sideways, kind of holding on to support. Then we broke out to our final high. In this case, it was June, July. The one that we saw was more like September, October in 2018. But after falling or excuse me, after breaking out and putting in that top, look at the steep decline here. Does that remind you of December? Breaking down below the prior low on a steep drop, 370 down to 305. We're talking about just about 20%, not quite 20% here. But then we did eventually get more than 20%. But look at the rally here, 7%. You see these prior lows, 325, 330. And where did we get to on the rally? 325, 330. And then we went back down and went to a lower low. But notice here, lower prices, positive divergence, higher PPO. Once we bottomed, we went to a lower low, put in a double bottom, little head fake. You can see that tail just slightly below the prior tail at the end of September. The one in October goes down just a little bit lower. Then we take back off again. The secular bull market kicks back in. I think we could be looking at something like 1991. Again, this one didn't last very long. July, at the middle of October, we're talking 3 months, 90 days, boom, done. So I think if we go back down one more time, we could be in that same time frame, maybe 90 to 120 days. Maybe it drags on a little bit longer, and you can see there were a lot of head fakes. It wasn't easy. You know, hindsight, we can look back at this and say, oh, yeah, I would have jumped in right here. But there were some pretty big moves back down that would have tested your theories and your belief in that secular bull market. And so I don't think this is just going to be an easy one trip down, right back up we go, and the bull market's off. I think there's going to be a lot of emotional ebbs and flows as we look forward in 2019. So that's kind of what I wanted to go over and give you a little sense of history and maybe some things that we should be thinking about as we approach the S&P 500. Notice this 2580, 2590 level was right at about those price support areas that we had previously. Remember, on the way down, 2581 was the low back in February. Aaron on the show has been talking a lot about 2600 the last few months. 2600 been holding, and now here we are, 2580 to 2600. I know everybody's excited about the rally, but Mary Ellen, I'm still a little concerned about the possibility that we roll over, and maybe we need to get that second low before the secular bull market continues. Just one opinion.
Yeah, and realistically, those headwinds that brought us down from that October to December period are very much still in place. Tariff fears, and again, these earnings season is really going to be quite telling as far as what we can look forward to over the near term.
And I think too, the international markets have been weak. They were weaker than the U.S. for a long time.
Absolutely. Yeah.
And a lot of our S&P 500 companies are multinational companies. Most of them are doing business throughout the world. So if those markets are down, you got to believe that some of these S&P 500 companies are being impacted by that as well. Anyhow, here's our poll for the day. We always like to talk about some of these, big companies that everybody likes to know what's going on. Amazon, Microsoft, Google, Apple. Facebook would have been in the list, but the stock's gotten beaten up so bad. I don't think really it has a shot. At least I don't think in 2019 that it'll be the highest market cap. But that was the question today. So here's the current market caps, or at least as of 11 o'clock this morning. And wanted to see what everyone thought in terms of the end of 2019. Who's going to be the top dog? What do you think, Mary Ellen?
Yeah, I'm going to say Amazon, and I do see more than half of the individuals that polled think as well. And of course, Amazon has that double-edged sword, if you will. They do have that incredible presence and space in retail, online retail to be particular. They're coming out of a phenomenal recent season, holiday season, but also they have the technology, and their cloud computing space has been growing for years now, and it's becoming, and it is the dominant player in that space. And so they're in two very specific and very strong high demand areas of the economy. So certainly Amazon, of those positioned, does appear to be best.
Okay. Yeah. That's fair enough. I'm gonna go with Microsoft. If you look at the weekly chart, it's the only one trading above its 20-week moving average. I think it's been the best performer. It's near the top. I think Microsoft will be the top one at the end of the year, but we'll see. All right. I want to thank everybody for tuning in and joining us today. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Friday afternoon, everybody. Enjoy your weekend. Be safe. We'll see you back here on Monday. Happy trading.